Ss2 students, how do you do? Hope you're safe at home. I welcome you back to Ss2's online tutorial platform, and I remain your host, Mr. Linus. Last week we started with the topic taxation, and this week we're going to continue from taxation. Then the subtopic is direct and indirect taxes. Direct and indirect taxes. And our takeaways are, upon conclusion of this lesson, you should be able to define tax, direct tax, and explain types of direct tax. B. Explain indirect tax and outline types of indirect tax. And the last specific objective, identify and explain 16 of taxation. Stay tuned. What then is direct tax? By definition, direct taxes are taxes levied on the income of individuals or organizations by the government or its agency. Such income includes wages, salaries, profits, rent, and interest. The burden of direct tax is borne by the payers. The taxpayers are usually aware of the payment and the amount to pay. Now listen very closely. When you talk about direct tax, one of the things you have to take hold of is it is paid directly by the taxpayer to the government or its agency. That's number one. And direct tax is not shifted. It cannot be shifted from one person to another. When we go to the types of direct tax, you understand more. One of the examples or one of the types of direct tax is personal income tax. For instance, I pay my tax as a worker, as a staff of Ss2 International. So I pay my tax. I cannot transfer my responsibility to another person. Civil servants pay their taxes. It is different from indirect tax, which can be shifted from one individual to another. We also have company tax as one of the examples of direct tax. Ss2 International as a company, which is an institution of learning, cannot transfer its tax responsibility to another school. It cannot transfer its tax responsibility to another school. So it is its responsibility to pay the due tax. So direct tax is paid directly, it is not transferable. And it is levied on what? Income. I put it this way, it is levied on money and not product. It is levied on money. That being said, let's look at the types of direct tax. Now you can see on the picture you have the taxpayer showing how it is, or the burden the taxpayer is carrying. So it's not transferable. The burden is being borne by the taxpayer. Types of direct taxes. You have personal income tax. Let's begin with personal income tax. This type of tax is levied on the income of an individual, usually during a period of 1 year. In this system, individuals are granted certain rebates such as whether married, number of children, etc., and the balance is taxed. In Nigeria, for example, personal income tax is based on pay as you earn, payee, and it is what? Progressive in nature. Personal income tax here talks about, now if you are listening very carefully when I was reading the definition, it says the balance is what is taxed. So the income of an individual, there's also what we call allowance. The room for allowance if the person is married, the expenses, if the person has children, then what is left for the person is being taxed, which is the tax base. So the tax base is the balance left, and that is what to be taxed. It is progressive in the sense that the higher you earn, the higher rate of tax you are bound to pay. The higher you earn, the higher rate of tax you are bound to pay. Next one is company tax. Company tax, also known as corporate tax, is a tax levied on the profits made by a company. Allowance is given to companies in the area of expenditure, and the balance, which is net profit, is then taxed. Now, what this is saying is, just like in the case of personal income tax, the company tax here, after depreciation, after expenses have been deducted from the gross profit, what is left, which is known as the net profit or net income, is taxed. So this one is paid by companies, while the first one, which is personal income tax, is paid by individuals, earners, salary earners. This one is being paid by companies, manufacturing companies, institution of learning, and telecommunication companies, which is under service company. They all pay their taxes. The next one is poll tax. Poll tax. This is a tax levied equally on each person residing in a country, regardless of the level of income. Listen again. Poll tax is levied equally on each person residing in a country, regardless of the level of income. This type of tax is regressive in nature. In other words, the higher the income, the lower the rate of tax. The higher the income, the lower the rate of tax. So the poor people bear the most burden. Example of poll tax is in United States of America, when they were preparing for election, all citizens were mandated to pay a token amount to enable them vote for an election. Such rate, the rate that was actually given was a flat rate, no description, no discrepancy, no difference. So each citizen was meant to pay the same amount of what? Tax. The same amount of what? Tax. So the rate was actually the same, both for the rich and for the poor. So who bears the most burden? The poor. So it's regressive in nature, in the sense that the higher the income, the lower the tax rate, because actually the person has actually outgrown the level, while the lower the income, the higher the burden, because the person has to bring out or cough out a huge amount of money to be able to pay his or her tax. Next one, capital gains tax. Capital gains tax. What then is capital gains tax? You may say. This is a tax imposed on the gains made from the sale of the capital assets. I repeat, capital gain tax is the type of tax imposed on the gains made from the sale of the capital assets. We have capital assets as properties, land, cars, and other capital assets. So what is taxed is actually the gain, the profit made in the sale of such capital asset. It could be land, it could be car, it could be building. So the gain made from the sale is what is actually taxed. So it is called what? Capital gains tax, and it is a direct tax because the owner who makes the sale actually pays direct to the government. It's not indirect. The next one is expenditure what? Tax. This is the type of tax levied on the part of a person's income, which is usually spent. It is not a very common tax in developing countries, but it is used to encourage savings. Now, that portion of money or that amount of money an individual usually spends is what is actually in consideration here. That is the amount that is actually being taxed. So that portion is being taxed to reduce and also to reduce the amount of spending carried out by the individual, and in the long run to increase what? To encourage savings, which will help the person to embark on investment. So the idea is to encourage savings. That's the idea behind expenditure what? Tax. The next on our list is we're going to talk about indirect taxes. Haven't done justice to direct taxes. Now we're talking about indirect taxes. What are indirect taxes? Indirect taxes are taxes levied on goods and services. Note, they are taxes levied on goods and services. You may write them out, goods and services. Remember, when I define direct taxes, I say they are taxes levied on what? Income or money. It could be wages, it could be salary, it could be rent, it could be interest. The producers or sellers bear the initial burden of tax before shifting it to the final consumers in the form of higher prices. Here, the initial burden is being borne by the producer. Then it's transferred to the final consumer through the wholesaler. From the wholesaler to the retailer then transferred it to the final consumer, who bears the final burden. So indirect tax is not paid directly by the taxpayer. How do I mean, or what do I actually mean? The ultimate taxpayer is who? The consumer. But the person that makes the payment is the producer in a little amount. But the ultimate taxpayer is the consumer, because the consumer pays a high rate of tax in form of prices. In form of what? Prices. Now what this simply means is, for instance, if I am producing car, for instance, and I'm charged that is excise duty, for instance, because I'm making it locally in Nigeria, then I have to increase the cost of the car. Then having increased the cost of car, the wholesaler buys from me. And the final consumer, which is an individual that wants to use the car, comes and buys from who? From the wholesaler. That individual actually pays the ultimate price, and it's just like the person makes the ultimate sacrifice. Is the person that pays the highest rate of tax involved. The producer made the first payment, which is in form of excise duty, but the producer gets the money back from the wholesaler, who gets it from the final consumer. In case of 3 chains of distribution, but in case of 4 chains of distribution, then the retailer comes in. So indirect tax is transferable, unlike direct tax. Indirect tax is not cheap; it cannot be shifted. It is not transferable, but in indirect tax, it is transferable. Another person could pay it in form of high prices. So that's one of the differences between direct and indirect taxes. In our last class, I gave you guys assignments. Most of you did very well. So we are still talking about it. Unlike direct tax, the taxpayers under indirect tax are usually not aware of the amount being paid for such. As simple as that. So all they know is that the price of the commodity is so and so, maybe it's way too high or way too low. But they pay in form of prices. They are not called taxes to them. So maybe that definitely every producer wants to make profit. The producer will definitely increase the price of the commodity, and the buyer, maybe the wholesaler, the retailer, or the final consumer, will definitely pay a way higher amount so that the producer will make profit. They are called indirect taxes because the tax assessment was not in respect of the final payer. Now, what that simply means is that the person making the final payment is not actually aware why or what she's paying for, or the reason this payment is like this. All you know is that the price is too high. If he has the money, he makes the payment or she makes the payment. So it is not direct. It is paid indirectly by the ultimate payer without knowing, in form of high prices. Now we'll talk about types of indirect tax. Types of indirect tax. We have excise duties. Excise duties are taxes levied on goods manufactured locally. They are levied on goods manufactured locally or locally. So here, excise duties are like tax paid by local industries. They are tax paid by local industries, or you may say indigenous industries. So any industry operating within a country and they are charged to pay a certain amount of money, what they are paying is termed excise duty. I gave you as an assignment one of the objective questions. Someone asked me in a private comment with respect to the assignment because the person failed the question. She asked, what then was excise duty? Which I replied. So it's the payment made, taxes or duties made on locally manufactured goods, not imported, not exported, locally made goods. The duty or tax paid by local manufacturers is termed what? Excise duties. Most times they are placed on certain goods, not all goods. Because goods that are actually beneficial to us or to the country, they are actually encouraged. They are given tax holidays. Government gives such industries tax holidays to enable them to produce at a high rate. Excise duty, you may put it, they are imposed on certain commodities made locally. Maybe cigarettes, to discourage a harmful consumption. The next one is value-added tax. Value-added tax. This is a type of tax imposed on goods and services at each stage of production. Value-added tax. This is a type of tax imposed on goods and services at each stage of production. The burden of tax is finally borne by the final consumers. It is used to generate revenue for the government. To have example, recently, I think 3 months back, the VAT on airtime, that's recharge card, was increased. So government actually uses such to do what? To generate revenue, to bring money into the government's pocket. So value-added tax is being introduced. Now, there's a point I want you to take. Say, this is the type of tax imposed on goods and services on each stage of production. So an objective question may come this way. Dash is the type of tax imposed on each stage of production. So you don't need to think twice. It's value-added tax. So as the value increases, the tax on the commodity increases as well. So that is what the point is saying, value-added tax. As the name implies, so it is. The next point is custom duties. These are grouped into two. Either you call it custom duties or custom tariffs. Custom duties or custom tariffs. Now you have import duties and export duties. Please, import duty is different from excise duty. Export duty is different from excise duty. Take notes. Like I said earlier, excise is about locally made goods. Exports, imports, listen and get the explanation. Import duties are taxes levied on goods brought into the country from other countries. They are paid by the importer. So bringing in commodities, you've heard of AOK. That is maybe all fairly used mobile phones or laptops. The importers actually pay a certain amount of money. Now, such amount of money paid by those importers is termed what? Import tax or import duty. So it's the amount of money paid by importers to bring in commodities from another country into their own country. Next one is what? Export duties. These are taxes levied on goods sent out to other countries. Such tax is paid by the exporter. Such tax is paid by the exporter. So the person transferring goods or commodity from its originating country or its main country to another country is called an exporter. In other words, you're selling out. One of the stores or one of the commodities who transfer or export in Nigeria will export some cash crops like rubber, cocoa, groundnut, cotton, even vegetable to some countries that don't have. So the exporters, they pay a certain amount of money to the government to export locally made goods from their country to another country. Nigeria is a case study, from Nigeria to maybe Ghana, US, United Kingdom, China, or what have you. So the amount of money paid by exporters, people, those marketers or traders that transfer goods from Nigeria to another country, the amount of money or the money paid by those people to the government to enable them transfer their goods from Nigeria to another country is called what? Export duty. Next point. We have types of indirect tax continues. Sales tax. This type of tax is levied on the sale of certain commodities. The tax is collected either at the wholesale or retail stage and passed on to consumers in the form of higher prices. Now, examples are fuel tax, alcohol, tobacco products. Now, This is used, one of the reasons is to generate revenue for the government or to the government, and also is used to discourage consumption of harmful commodities in the case of tobacco. In case of fuel, it's used to generate revenue. And most of the times, sales tax is levied on essential commodities. Essential commodities. Essential commodities are those commodities you actually need almost every day, now and then. They are essential to us. They are important. We actually make use of them almost every 2 to 3 days. We have clothing, we have some certain foods we eat, or even eating out. So government may decide to generate more money or to generate revenue. By so doing, they may decide to increase the rate of tax and the consumption of certain commodities, certain essential commodities. So that type of tax is called sales tax. Now it says this type of tax is levied on the sale of certain commodities. The tax is collected either at the wholesale or retail stage and passed on to the final consumer in form of higher prices. The last but not the least on the type of indirect taxes, we have purchase tax. This type of tax is levied on certain consumer goods or commodities, such as cars, television sets, etc. This tax is usually collected at the wholesale stage. The first one I said is collected at either wholesale or retail stage. But this particular one, which is the purchase tax, it is usually collected at the wholesale stage. It is based on the value of goods under consideration. Luxury goods attract higher purchase tax than essential goods. But let me say this: purchase tax is usually imposed on non-essential goods like cars, like television sets. To some people it's essential, they are essential, but generally they're not essential. You can do without them. So essential in a sense you cannot do without, but if you can do without them, they're not that essential. So purchase tax is used on most non-essential commodities. They are used on most non-essential commodities like luxury cars, gold, and what have you. Luxury items. They are also used by the government to generate revenue. Next on our list is classification of indirect tax. Classification of indirect tax. We have ad valorem tax. Ad valorem tax. This is a form of indirect tax in which the amount of tax paid varies according to the value of the item purchased or sold. This is a form of indirect tax in which the amount of tax paid varies according to the value of the item purchased or sold. For example, if a 10% ad valorem tax were to be imposed on shoes, the tax payable on shoes valued at 10,000 naira would be 1,000, which is the 10%. While a car valued at 50 million naira would attract 5 million naira tax. So here, ad valorem tax is placed on, it's a tax according to the value of an item. It is a form of tax imposed according to the value of the commodity. Now it says it's a form of tax of indirect tax in which the amount of tax paid varies according to the value of item purchased or sold. So the emphasis here is on the value of the item. So ad valorem tax is that type of tax that is levied according to the value of the commodity. So the higher the value of the item, the higher the rate of tax. The higher the value of the commodity, the higher the rate of tax. The next classification is specific tax. In this type of indirect tax, a fixed sum is imposed or levied per unit of a commodity, irrespective of its value. Here, the value is not being considered. Example, equal percent of tax is levied on both luxury and essential commodities. I repeat, equal percentage of tax is levied on both luxury and essential commodities. So what this is saying is there's no consideration for the value. So the amount is a flat rate. It's a flat rate tax system. In this type of indirect tax, a fixed sum. So it's not about the value, it's a flat rate system of taxation. While the other one is placed based on the value of the commodity. Hope you know the difference. Ad valorem talking about the value, the other one no value at all. Each commodity or each taxpayer pay the same amount, or each commodity is taxed equally, no discrimination, nothing like luxury or what have you. Next point. Now we have 16 of taxation. 16 of taxation. Please look very closely to the graph, because the graph will help you to understand the definition of each 16 of taxation. Number one, have progressive tax. This is a form of tax in which the rate of tax increases as the income, stock of wealth, or value of property to be taxed increases. A good example of progressive tax is pay as you earn, which is payee system. Now, progressive tax is common in civil service, or common among civil servants or public offices. So the higher you earn, the higher the rate of tax. Look at the diagram. You have the vertical and the horizontal line. The vertical line is the one standing, horizontal line is the one lying flat. So on the vertical line, you have percentage of income paid in tax, and you have 30%, you have 20%. You have 10,000, you have 20,000. Then 20% is meeting 10%, while 30% meet with 20%. You can see the graph, and you can see the arrow showing you the direction that as income increases, the tax also increases. As income increases, look at the horizontal line. You can see the movement from 10,000 to what? 20,000. The tax rate increases from 20% to what? 30%. That is what? Progressive. Now, the diagram could be drawn like, you can see another picture facing the diagram I explained just now. Also, now you have to know that under horizontal line, you have tax base, and the tax base is the income. While under vertical line, by the vertical line, you have what? Tax rate. Know the difference. Tax base is the item being taxed, which could be money or commodity. While tax rate is the rate at which the taxpayer will pay the tax he or she is due to pay. Then you have the other diagram facing the first diagram I explained. It means progressive tax could still be drawn like that. So it must not, if you look at the direction, they are going the same. The first diagram is facing downward, while the other one is facing upward, but almost the same direction. So it's upward. As income increases, tax rate increases. Next point is proportional tax. Proportional tax is a form of tax in which the rate of tax is the same, irrespective of the level of income or wealth. I repeat, it is that type of tax in which the rate of tax to be paid by taxpayers is the same, irrespective of what? Irrespective of the level of income or wealth. The first one, which is progressive, the person is meant to pay according to the person's income. While the second one talks about flat rate. Now, let me complete the sentence. It says, it is a system in which the taxpayers pay the same percentage or proportion of their income or wealth. Example, the company tax. Here, companies are required to pay a fixed percentage of their profits as what? Tax. Where the company is making so much and another company is making not enough amount of money, that is slightly below the other competitive company. So they are meant to pay the same amount because they fall under categorical companies. So here they are not charged differently. They are charged absolutely the same. Another example is poll tax. Poll tax, everyone pays the same, irrespective of the person's income or wealth. So you can see from the diagram, the first one, you have proportional tax. You have as income increases, the same amount of tax, the tax is the same. An income earner of 10,000, 50,000, and 100,000 are paying the same rate of tax, no change. So who is winning here? The high income earner is actually at the advantageous side, while the low income earner or the poor income earner bears the most burden. Please take note when I say burden. It matters a lot. You may see it in your OBJ question, either in WhatsApp or your UTME. Now you can see the next diagram also showing the same thing, but that one doesn't have figures attached to it, both vertical and the horizontal lines. So here, the taxpayers are meant to pay the same, notwithstanding the level of their wealth or income. And the next one, which is regressive tax. Regressive tax is a tax system where the tax rate decreases as income of a consumer increases. Take note, tax rate decreases as income of the consumer increases. Now, if you understood the law of demand and supply very well, this is actually what the thing looks like. So you know, in the law of demand and supply, when price increases, demand does what? Decreases. So this one is saying that when income increases, the rate of tax decreases. In this case, the higher the income of a consumer, the lower the rate of tax. Note, in regressive tax, a poor person pays higher proportion of his income than a rich person. A good example of regressive tax is poll tax. I used poll tax as an example when I was explaining proportional tax. So here is also a good example. Now, how is it a good example? They are paying the same thing, for instance. When poll tax talks about using flat rate, here, if the income earner has an increase in the rate of income, the person is still meant to pay the same thing that a low income earner is earning. Now, if the rich man increases his profit and the income has increased, for instance, and the poor income earner has no increase in his income, he's still going to pay the same thing. Therefore, even when the income of the rich man increases, the person is still paying, well, I say he's paying lesser. That's what it is. Because as the income increases, he's paying lesser amount of what? Tax. Why the poor income earner? Because there's no increment, he is paying almost the same. And he's paying, not only the same, he's paying higher. He's actually paying higher because the value of the tax will increase. Now, I say in regressive tax, a poor person pays higher proportion of his income. Higher amount, that's what that proportion means. Higher amount of his income than a rich person. Now, let me give you a case study. If someone is earning 50,000 naira, another person is earning 300,000 naira, you agree with me that if they are to pay in regressive, they are saying that the higher you pay, the higher you earn, the lesser you pay. Why the lower you earn, the higher you pay. Now, what it simply means, like here it says, the income increases from where? 10,000 to 30,000. And what is the tax? The tax is 10%. Regressive means it's opposite. They're not going in the same direction. They are going in opposite direction. That's another word to liken to that word regressive. While progressive, they are going in the same direction. The higher the income, the higher the tax rate. But this one, the higher the income, the lower the tax rate. So they are going in different directions. The tax base, which is the income, is going in one direction, while the tax rate, which is the rate at which the person is meant to pay his or her tax, is going in opposite direction, a different direction. So here, by that note, you say in regressive, a poor person pays higher, because since the person is meant to pay higher as a result of the low amount of income generated, while the higher income earner is meant to pay lower because of increasing what? Income. So that is what regressive is all about, and the diagram explained it very well. So please make use of the diagram whenever you want to answer a question with respect to regressive or systems of taxation. In our next class, we're going to be looking at incidents of what? Taxation. Incidents of taxation. Here, incidents of taxation and some concepts of taxation. Some concepts of taxation. We're going to draw the curtain here. Thank you very kindly for your audience. Hope to see you guys soon. Please do the assignment that follows. Let's go to the assignment section. Number 1, an example of an indirect tax is dash. Pick the correct option. Number 2, an ad valorem tax is imposed on dash. Pick the correct option. Third one, a form of tax in which the rate increases with increase in income. Pick the correct option. Number 4, explain 3 importance of import duties. 3 importance of import duties. Thank you very kindly. Stay safe.